Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas. I am the co-host here alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent economic news and statistics. We will also discuss, is there a best day to sell? Recession flags, consumer spending, more on the spring market, and so much more. But first, like usual, Stephen, what's going on in the Thomas household?
Well, it's spring, so we have kids that go to various schools, and we have two different spring breaks. Thumbs down. So we had our high schoolers had spring break this week. We get a break next week, and then the following week we have our middle school and Ezekiel in the first grade. They have their spring break, so we're in the midst of spring breaks season. And that means a few different distractions as, of course, they want to do things that are fun, all that good jazz. And then we also, in the midst of it all, still have sports going on with basketball. Zeke, soccer, Mason, and Alana and Athena are busy with track. So that's what's going on. That's it. Spring break in sports, and that's about it. So how about you? What's going on with Brennan Joseph?
Yeah, same old for me too. Just exciting things coming in the next month or so with stuff that we will offer and we will announce, of course. But outside of that, I mean, it's pretty same old, except my favorite soccer player or football, however you like to say it, um, is going to be back, I think, this upcoming week. And he's been out for so many months, and he's like one of the most influential people on our team. And he's just going to make watching the sport so enjoyable because it's been a little bit dull without him. It's been hard, but I enjoy it nonetheless. But outside of that, what's happening in the real estate world with supply demand and our very own expected market time?
Yeah, there are very, very few exceptions to this. Pretty much in all markets, we're still getting inventory going up at a faster clip than it has over the last couple of years. So we're seeing inventories rise, and the almost all markets we saw flat to even some markets down demand. So if you have there's only like an exception or two in that, but for the most part, if you aggregate them all together, we're getting increased inventory at a faster pace than demand. And when that happens, that means that we've already passed the hottest point of the year as far as the, and typically that's the spring market. We can peak anywhere as far as expected market time. The speed of the market is typically in March is done, so people go, spring, that is the absolute best time. And actually we have more and more homes come on the market at a faster pace than demand is going up, because demand will reach its peak coming up. So if you have inventory going up faster than demand, the market is feeling a little bit slower. Now, the big giant difference is this spring is noticeably slower than last spring, or the last couple springs, last several springs. This is actually a slower season. So everybody's feeling these shifts, and it just boils down to being priced right. So what ultimately, that's the overall gist going into this very first week of spring that we are enjoying. But it's lines up as the most demand, but there's more competition out there from sellers.
And it seems like mortgage rates have been stuck just above 6.7%. It's been hard to break that barrier for an actual long time. I mean, I can't even recall the last time that we really broke it. I mean, it's been quite some time. However, what's happened over the last couple of weeks with economic readings that would impact mortgage rates?
Yeah, we haven't seen much movement in rates. We came down to 6.76 today. We're actually recording this on March 28th. So came all the way down to just slightly, and we seem to be stuck right there. 6.75 is about all that we could do. We're waiting for the other shoe to drop with something in the economic numbers. Economic numbers have been kind of a mixed bag. Things show that it's slowing down, and there's a lot of tariff talk, and so people are worried about inflation, and then we're also worried about retail sales. So it's kind of been a mixed bag. And then the Federal Reserve met last week for their March meeting, and it's a very, very important meeting. They, of course, said they're not doing anything with rates. No surprise. The whole market already knew that. So, but the biggest thing that came out of that is every other meeting, they meet every 6 weeks, but it's a big meeting where they talk about where they think rates are going to go for the remainder of the year, and then where they're going to go for the following year. And really, the average of this year and last year, because they have a whole bunch of voting members, it has not changed at all this year and next year. So, but there are a few more people this year that are saying, yeah, we might not do anything. It's a few more, but on average, what they're talking about is 2 federal funds short-term rates. That's already priced into the equation. In order for us to get down to like 6.5%, we need to see something else break, like probably on the labor side of things, for it to go down a little bit further. Now, PCE, that's Personal Consumption Expenditures Index, that's like CPI, but it's the one that everybody on the Federal Reserve looks at a little bit more closely. And that one came out today, March 28th. And that basically was a slightly elevated compared to what the sentiment was as to where it was supposed to be. Last month, it was slightly less. So if you take a look at the two and you combine them, it's like a big nothing burger. And that's why the market didn't even move at all on PCE. It actually, today, the 10-year Treasury yield and also interest rates came down, and quite a bit on the 10-year yield. And the reason for that is because there was one of the big consumer sentiments that came out. We got one, this is our second one, and both of them are showing that it's continuing to dive down lower, showing that consumers are not very confident about where things are going right now, and also into inflation down the road. They're very concerned about inflation. And this is not just a political thing where it's a red versus blue on how the sentiment has been working out. It's actually on both sides of the aisle. It's pretty much everybody's kind of feeling this way, and there's a lot of angst. Because one of the charts that we use is the economic volatility index that's out there, and it is the most volatile that we've seen since the pandemic. And that was this thing goes back to the 80s, and it's only been higher once, and barely higher than where we are right now. And that is when we were in the midst of a lockdown, wondering what we were going to do. That's kind of where we are right now, because we're kind of the economy, small businesses, large businesses, everybody's wondering, okay, where are we going from here? Because they're wondering and worrying about tariffs. Because tariffs, they've heard that it's going to affect the pocketbooks of everybody out there. So as a result, when everybody's hearing that there's inflation down the road, that their pocketbooks are going to be less, they're going to end up spending more because of tariffs. Now there's a lot of pushback as to, you know what, maybe it's going to be a little bit more negative later on this year, so people are saving. And when they start saving and not spending, that's where we get into a problem where GDP comes down. And that's why the more tariff talk there is, and the more where because this has been punted down a couple times. We're already to April, and this was supposed to already have happened, but it's now the start of April, but we're just about to the start of April. We're going to hit another one of those deadlines. Are we going to get another punt further down? Because that's what the Wall Street's expecting. But if everything locked in and we actually had these tariffs and they were locked in, said, that's it, we're doing them, boom, 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 and all the doors come down, it's going to cause reciprocal tariffs around the world, and there will be a trade war that ensues. They've already threatened it, all these different leaders around the world. So as a result, at that point, that's where you're going to see even more breakage, because you saw Wall Street come down, and then it's kind of been bouncing around, and it hasn't gone down further. And the big reason for that is because they're still hoping that there's going to be some easing in tariffs. And there was the rumors of easing in tariffs on Monday, right before the opening of Wall Street this last Monday. And then all of a sudden we had the stock market go bonanza over rumors. And then the very next day we're talking about more tariffs, and now we're talking about auto tariffs, and it's just these continuous news cycle feeds of all these tariffs, and it's just creating a lot of confusion out there. And confusion means that they don't know how to plan. So if you don't know how to plan, that's going to gum up the works of the economy. You're going to see that with small businesses, large businesses, as well as consumers altogether, kind of like not doing what they normally do because it's kind of like a wait and see. And this is one of those wait and sees where it really is going to have a drag on the economy. And it already is beginning to have that drag on the economy. We just don't see them in all the numbers, but it will come as time goes. So that's really what we're looking at right now. It's more of consumer sentiment, where we're going to go right now. It's not showing up in all the numbers, but if you get this kind of sentiment and it really has a stronghold with where consumer sentiment has fallen to, it translates to the overall economy. That's what it's done in the past, and those are the numbers that are coming in right now. Usually, I'm not a big fan, by the way, of surveys, but when consumer sentiment drives down, this is where my concern raises.
So something I wanted to touch on is how we're really entering the thick of the spring market. And of course, it's super hard to navigate with now what feels like a slowing market. But I found an article that says on average, home sellers who list their properties in the week of April 13th to April 19th could sell for roughly $27,000 more, according to a recent report by Realtor.com. So, Steven, do you see anything like this actually happening, or is this something they created to catch headlines and to give, I guess, good belief for people to actually sell their homes during this time?
It's actually for clicks. The whole thing is for clicks. It's one of those, it's when I see an article like this, it just makes me cringe. This is a cringe-worthy article, all for clicks, and you can basically you're looking at median sales prices. You're not really looking at true values. If you look at home price indices, it doesn't all of a sudden have this big giant uptick because of this 1 week in April. That's not what it is. Now, typically what happens with the median sales price, the mix is where you get a lot more in the upper range. There's kind of like this shift up in the number of closed sales in the upper ranges that happens between April 13th and 19th. And that's just the study going backwards. So when do those close? Typically, because you're now mid-April, typically 45 days out, which is June. June is home to typically the highest median sales price for the year. Median sales price is just the middle value. It's taking all home sales and stacking them up on top of each other and taking out the middle value and say, that's the median sales price. Now, while it can tell you it's an okay indicator to tell you which way the market is moving. But here's what happens after June. You start to get an easing in the median sales price where it's going like down. It's not really going down. Price values are not going down. You can get some values go down towards the end of the year recently over the past several years where we've had interest rates that have gone higher, and that has created this is a slower time of the year. You have interest rates that are going higher. In order to get sold, you kind of have to be a little bit more relaxed in price, and you can get some easing in prices later on. But really, that median sales price is not really a true indicator. I'm talking real home values that we're watching. So this is a good patch. Always spring is a really good patch, but I've already explained that as far as the speed of the market's concerned, the speed of the market, the fastest part of the market is probably in most markets already behind us, at least in the sunny areas, because it's been cold in part of the other in the rest of the United States. So those markets can see the spring market. They can see it continue to rev up, but it's not going to rev up for too much longer. It usually comes at the end of winter. So if most markets hit March and then some of these colder markets that are starting to warm up, you get into April, that's about it. And then you have inventories coming on way faster than demand's going up. And so I don't think that I really don't like these clickbait headlines, and it drives me a little bit crazy, especially when you read the articles and they're still there. It wasn't just clickbait. They're trying to support it. And I don't think you should be supporting anything like that.
So, something I wanted to ask you is if mortgage rates do happen to drop later in this year, could we see a significant pickup in expected market time? So, the speed of the market later in the year. So, say if mortgage rates drop to six, what would you think would happen in that scenario?
Yeah, absolutely. We would see all of a sudden a lot more activity. It would be substantially more. When you get a lot more demand, and especially later on in the year, you're actually going to get inventories that are coming down a little bit, and then you get these rises in demand. Expected market time, the speed of the market actually speeds up, and we had that for a short period in many markets back in September or October, right around there, depending upon which market you were in, and that was all because we had these lower interest rates for a while during the fall of last year, and we actually witnessed it. But we just, if we're there with duration, if we can get below 6.5% with duration, man, it would be absolutely incredible for the real estate market. You'd see a definitive shift.
It would be night and day. That's right. So, according to Resi Club, for every five US homes, three have mortgages and two are mortgage free. So, what does this mean for the future of residential sales?
Yeah, it's actually been like this for a while, and so that's an interesting statistic, and that means that there's a lot of people out there, if there are five homes, two don't even have a mortgage, they can sell and they don't really care about being their low interest rate because they don't have an interest rate. They could trade that equity for something else. So then the ones that do have a mortgage, it's been such a long time since we've been below 6% that it was August of 2022, and I'm even losing the math at this point because it's been so long ago in the rearview mirror that more and more of these people will be inclined to purchase or sell their homes and buy something else as time goes on, because they're just there's a lot of life circumstances. Families get larger, they get smaller, people need to move in other areas, they want to move closer to kids. There's a lot of different factors that go into this, and the longer that we go on and people are waiting, after a while people get tired of waiting and more people start to sell, and that's exactly what we're seeing right now. So as far as that statistic's concerned, it just talks about the mobility of homeowners, and those three out of five, they're going to be more and more inclined as time goes on to place their homes on the market and sell as well.
So, as of today, March 28th, how many recession flags are you seeing? Would you be able to break down the six flags that we look at?
Yeah, so this is Fed increases rates is the first one. Now we had that flag go up way back when, and in 2022 and into 2023, yet still no recession, but that's one of six. You get the inverted 2 and 10 year, and that's actually improved over time, but it just has to be inverted for it to flip on, that you get that it is an indicator of a recession. So that one went. Unemployment falls below 4%, which it did, and now we're just slightly above 4%, and that also is an indicator of a future recession. And then housing starts fall, which is also happening. So there you go. Why that is one of them that we follow is because if you see that housing starts fall for a while and you need two consecutive quarters. Now, this is really the one that we have to watch the closest, because you get two consecutive quarters, what will happen is builders will start laying off some of their employees, and now you're going to get a lot more added to the unemployment doles. And that's why we're actually watching that one probably the closest, because that one is not raised. Leading economic indicators falling. It has been stuck for a long time at lower levels, so that's something that has clicked off. And then retail sales fall and supply spikes. Have not necessarily seen the spikes in supplies, but there has been a lot of purchasing of inventories in preparation of these future tariffs. There could be a lot of, and we've already seen, the number of retail sales starting to drift down, We actually had a negative number in January, slightly positive in February. Both of those less than expectations. Those are the ones that we're following, and as a result, you see that they're coming down. You're seeing we can have these inventories that they're sitting on, as well as you have retail sales coming down at the same time. That flag would be blowing, probably one of the strongest flags that are out there. So we're not really, those are the recession flags. We still don't feel that there's going to be a recession. It's starting to, there are some cracks in the system so that there could be one, but the base case is that for that not to happen right now. That's not what we're seeing, but things are beginning to slow down. So there could be the other flags, and then all of a sudden we have ourselves a recession.
So, on the topic of you talking about layoffs, Amazon, like many others, is planning to eliminate approximately 14,000 managerial positions within its organization between the first and second quarters of 2025, according to Layoff Tracker. So, what can we expect from the unemployment rate, since it feels like all we're hearing is federal and large layoffs from big corporations?
Yeah, it's funny because we've been hearing about layoffs for years now. It was the .com area where we were seeing a lot of tech, and they all make headlines. A lot of this stuff makes headlines. You could actually see with the number of cuts that's going on in the government, this will start to affect. We're not necessarily in an unemployment because a lot of these people have been granted these long severance packages, so they're not going to be signing up for these unemployment, getting their unemployment claims long term either. So but it will show up in other areas of surveys and things like that. So we will be watching that very, very closely, and it will start to show in those kind of numbers. So overall, it's going to start to show next week. I believe that next Friday we're going to see, because it's Jobs Friday, the first week in April. We'll be looking at next Friday, I don't even remember what day that is right now. I think it's the 4th of April. That's going to be a very telling day, because that's going to be where you might see some cracks that could push the 10-year treasury and mortgage rates down a little bit. So we'll be watching that closely. Amazon has so many employees that when they start talking about laying off this or that, I just take it with a giant grain of salt, because they're so large that this is a tiny little fragment of their overall workforce, and it might just be a restructuring of the way things have worked in the past. And and I don't know the nitty gritty nuances of that. Yeah, I don't follow all of them that much, but the same thing has happened with a lot of the tech over the last couple of years too. So I can't tend to take any of these giant layoffs and talk about it as this is going to be a problem across the board, because I really don't think Amazon's really hurting that much. I don't think that people aren't purchasing as much. Hey, I mean, there could be some retail sales that are down, but it's easy for them to pivot really fast and lay off a tiny fragment of their overall number of employees that they have, because they employ so many across the country.
The wealthiest 10% of American households, those making more than $250,000 a year, roughly, are now responsible for half of all U.S. consumer spending, according to Bloomberg. So is the Federal Reserve looking at the right statistics when going over consumer spending, especially if the wealthiest 10% are spending much more than those others?
Yeah, this is another one of those catchy little headlines. And the reason for that is because the upper echelon is responsible for a lot of, they could be responsible for a little bit more of consumption right now, but they typically are responsible for a larger portion of the consumption. It's like picking out. Of course, they're going to be spending quite a bit. So yeah, they will be a big piece of it. But there are definitely some telltale signs behind the scene that support this kind of a article. I don't know how much they got into credit card debt. Didn't read that article, but the credit card debt, we have a higher delinquency rate. We have not only a higher initial going into delinquency rate, but we have a higher going into 90 days behind delinquency rate in credit card debt. Credit card debt has ballooned, and there's a lot of people that are behind that have been waiting for maybe interest rates to come down so they can do different things. And with there are a lot of the people in the lower income brackets that can't quite afford these higher prices with inflation, with the lifestyle that they had, so that they are a little bit more jammed as far as their credit card is concerned. They're kind of tapped out, which will cut into future GDP. So there's a lot of this behind the scenes where you hear it and you think, we've been actually talking about this for the last year and a half, because you could see it in the numbers in credit card area, that eventually this is going to come to roost where they have to pay these down, or we'll see a rise in bankruptcies. We haven't seen a rise in bankruptcies, and we haven't seen this sudden everybody paying it down either. So this definitely has to be dealt with. So we'll be watching those curves very carefully, because eventually there's got to be something that gives. So that's what we're watching behind the scenes, which will be very telling. And that's what this is kind of alluding to, that the upper echelon, who doesn't really worry about credit card debt and things like that, because they have as much money as they have, they're more inclined to continue to spend month to month.
The National Association of Home Builders Wells Fargo Housing Market Index fell to 39 in March, down 3 points from February, in the lowest level in 7 months. According to Bloomberg data, economists were expecting a reading of 42. Do you see a bottom anytime soon, or is this just more trouble for the housing market?
Yeah, see, this is actually the housing market. We're talking about new builds. New builds is this tiny sliver compared to the giant behemoth that is residential resale. So what they're referring to is the builder side of things. The problem is, what we've seen is that more and more homes have been coming on the market, so the inventories have grown across the United States. And there were more homes last year than came on in 2023, and we built an inventory as a result, because those extra homes that were coming on the market were being pit up against very, very similar year-over-year demand. And this year, the demand levels are still very similar to the last 2 years, and there are even more homes coming on the market. So there are more homes that are languishing on the market, and new homes is part of the competition. What they were getting away with was 2 years ago, where everybody wasn't placing their homes on the market. Inventories were still low across the United States because everybody was enjoying their low fixed rate, and nobody placed their homes on the market. And then, where did you go if you wanted to purchase something? New builds. They continued to make them, and then they started to make them in droves. Now, what the problem is they continued to do that while the inventory of residential resale was growing, and as a result, now they're competing against all these residential resale properties. And so with all that extra competition, now they had more and more being built and being done and completed. Now you're getting these completions where we have standing inventory of new homes. We didn't have that problem before. So now they too have standing inventory, and the overall inventory is growing, and we have these interest rates that are stubbornly at 6.75%. So at the end of the day, now they can't sell things as quickly. They still have to place a lot of money at it to bring interest rates down to entice buyers to buy. But a lot of these people did that, and they had these 3-2-1 buy downs, and as a result of 3-2-1 buy downs, they thought, hey, you know what? At the end, we'll be able to refinance it. The interest rates will be down lower. They're not. So many people said, date the rate, marry the house. This is long-term dating, because we still have these interest rates stuck above 6%, and they have been stuck for going on 3 years this August. That is a long time for rates to remain the same. So as a result, what you're getting are people that are going, yeah, maybe this buy down thing might work, but I don't think rates are ever going to come down that much. And that's the overall sentiment, that we're no longer going to get these lower rates that people have talked about in the past, so that you can purchase and then refinance down the road. So as a result, it's taken the wind out of the sails of new home builders, and as a result, they're upset. and understandably upset. And that's because they had been able to just totally get away with building and selling and building and selling and no standing inventory. It was great. And it was all coming out of COVID, and people were waiting for things to be done. And now it's all caught up to them. And now they're getting a little bit more sluggish. So as a result, their sentiment has dropped.
And finally, before we conclude today's episode, the spring market. I mean, it's here, and obviously can be a tough cookie to navigate, since it's when housing really begins to pick up, especially leaving the winter market behind. So what are your tips as of March 28th for navigating the spring market for buyers and sellers alike?
Yeah, so we see more activity, and then it peaks. Demand does, pending sales activity during the spring. So there are more closed sales that arrive as a result of it. But the big misconception is that it's just going to get busier and busier and hotter, and it's great to be a seller. And I already said, if the fastest time on the market is now behind us, or for the rest of the country, that's the cold states, is within the next couple of weeks, it'll probably be its fastest time. After that, it just we get more homes coming in the market, demand not keeping up with the amount of homes coming in the market. It starts to get slower the longer it takes to sell a home. So to start off initially on the right foot at the right price is absolutely is critical, essential. We've talked about it so many times, and yet we still see that there are a number of price reductions across the United States. It is elevated at over, it's the most number of price reductions, and we're just going into the spring right now at this time of the year, going back over 10 years, which means a lot of people are just eager to jump in, and yet they're not ready. It's like they're jumping into the pool without a swimsuit. They're not prepared. They need to properly prepare. They need to spend the time on the pool deck, putting on sunscreen, have the goggles on and everything else, make sure the water temperature's okay, and then acclimate so that you price your home right, have it ready to sell so you can be a successful seller. That is so crucial, and is testing the market or leaving room for negotiations, or that padding or all these other foolish things that everybody believes in is just a excuses for being overpriced. And as a result, we have price reductions. And when you reduce the asking price, we have proved it time and time again, you will net less. And we just talked about that. That's probably a report that's coming in April that we will do, that reduce the asking price, net less. So in other words, get that price right. That is absolutely essential coming into this spring market. That's a lot more sluggish than a spring market that we have experienced in years. People aren't ready for it.
Well, thank you everyone again for tuning into another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, the Bay Area, Phoenix, or Las Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review, and if you have any questions, feel free to post it to any of our social media platforms, or you can email me personally at info@reportsonhousing.com. We will see you soon, and have a fantastic rest of your day. Thank you.
Thank you.